Hello everyone, welcome to Tesla Daily News. Today is June 22nd, Sunday, and the following is the latest Tesla news. According to International Business Times, Tesla CEO Elon Musk has issued a clear growth warning that directly affects how investors should think about the company over the next few years. On Tesla's recent first quarter 2026 earnings call, Musk said that ramping up production of the Optimus humanoid robot and the Cybercab robotaxi service will be far slower than many people expect. He emphasized that it is literally impossible to predict how quickly these new technologies can be built at scale. International Business Times notes that Musk framed the rollout of Optimus and robotaxis as a stretched S-curve rather than the rapid ramp some Tesla bulls have been hoping for. He said that initial output of both Optimus and the Cybercab will be very slow this year, and that any meaningful revenue impact should not be expected until around 2027. For investors, that means Tesla's high-profile robotics and robotaxi bets are unlikely to materially boost financial results in the very near term. The report explains that Optimus is not a side project but a central pillar of Tesla's long-term vision. Musk has repeatedly claimed that a mature Optimus business could be worth more than Tesla's automotive operations. However, on this call he sounded more like a pragmatic factory manager than a pure techno-visionary. He described the complex and time-consuming process of converting parts of the Fremont factory, particularly lines once used for the Model S and Model X, into facilities capable of building humanoid robots. According to International Business Times, Musk said you cannot dismantle a large automotive production line overnight. Even in an aggressively optimistic scenario, taking down the old line, installing a new Optimus line, and bringing it back up in working condition within about 4 months would already be insanely fast. He stressed that Tesla must troubleshoot more than 10,000 unique items for Optimus before reaching stable volume production. That language was less like a sales pitch and more like a preemptive plea for investor patience. The same article highlights how external expectations have already cooled. Prediction and betting markets, such as Polymarket, assign only modest odds that a consumer version of Optimus will appear by the end of 2026, and almost negligible odds for a launch by mid-2026. While these market probabilities are not official forecasts and should be treated cautiously, they underscore a growing disconnect between the most optimistic Tesla supporters and the broader investing public. International Business Times also reports that Musk dialed down expectations around Tesla's robotaxi and full self-driving ambitions. Online excitement and social media speculation have focused heavily on a possible Cybercab robotaxi unveiling in August and the idea that a driverless taxi network could appear quickly in key markets like California. Musk chose a more cautious tone. He said that unsupervised full self-driving or robotaxi revenue would not be super material this year, but could become material, and likely in a significant way, next year if technical milestones and regulatory approvals align. For Tesla enthusiasts, this is an important nuance. Musk is still confident that autonomy and robotaxis will transform the business model, but he is openly acknowledging sequencing, safety validation, regulatory green lights, and engineering reliability must come before any large-scale revenue wave. According to the same report, prediction markets currently see only a very small chance that Tesla launches a live robotaxi service in California by mid-2026, again suggesting cautious external expectations. The financial backdrop is equally important for stockholders. International Business Times states that Tesla plans more than $25 billion in capital expenditure in 2026, a very large figure even for a company of Tesla's scale. That money is heavily concentrated on next-generation initiatives rather than traditional automotive expansion. Key spending priorities include the Optimus production line in Fremont, a second dedicated Optimus factory at Giga Texas, the ramp-up of the Cybercab robotaxi platform, and a $3 billion semiconductor research fabrication facility focused on Tesla's AI and autonomy needs. International Business Times explains that this capital allocation reflects a strategic pivot, robots and chips instead of more conventional car plants. The company is essentially betting that robotics, AI, and autonomous services will drive the next era of growth. At the same time, it leaves the core vehicle business doing relatively less of the growth-heavy lifting, just as competition in electric vehicles intensifies globally. In its breakdown of the first quarter numbers, the outlet notes that Tesla generated around $22.39 billion in revenue, about 16% higher than the same period a year earlier. Non-GAAP earnings per share came in above analyst expectations. However, a closer look reveals a more complex picture. Services and other revenue segments grew by more than 40%, suggesting strong momentum in software, maintenance, and related activities. In contrast, energy revenue declined by double digits, and operating expenses climbed sharply, up more than a third, largely due to heavy spending on artificial intelligence research and development. For investors, this means Tesla is deliberately pushing costs higher today to build capabilities that may pay off years from now. The upside scenario is that Optimus, robotaxis, and AI infrastructure eventually justify the investment and unlock new profit pools. The risk scenario is that timelines slip further, regulatory or technical barriers prove higher than expected, or competitors close the gap in autonomy and robotics. Musk's own language on the call, stressing what he called literally impossible speeds and a stretched S-curve, suggests that even he wants to temper short-term expectations. According to International Business Times, Musk summed up this tension by effectively conceding that even for Tesla, some ramp-up speeds are simply not realistic. Investors who have grown used to ambitious timelines and bold promises may need to reframe their assumptions around the pace of change. For Tesla enthusiasts, the long-term vision remains incredibly bold, but the path may be bumpier and slower than some had hoped. According to multiple US and UK news outlets, including DNA India, The Independent, and the Daily Mail, Tesla is facing intense scrutiny after a tragic fatal crash in Texas involving a Model 3 that was reportedly using Autopilot or an automated driving assistance system. For both safety regulators and investors, this incident is highly significant because it connects directly to Tesla's brand, its Autopilot and full self-driving roadmap, and the regulatory climate surrounding autonomous features. Reports from DNA India and The Independent describe how, on a Friday evening in Katy, Texas, a Tesla Model 3 driven by Michael Butler veered off the road at what witnesses described as a very high rate of speed. The vehicle left its lane, crossed onto a residential property, and smashed through the brick wall of a house. Inside the home was 76-year-old Martha Avila, who was struck by the car in what family members say was her own living room or playroom area where her grandchildren often spent time. According to law enforcement statements cited by these outlets, Avila was airlifted by life flight to a nearby hospital but later died despite life-saving efforts. Her family says she was remarkably healthy for her age, on no regular medication, and that she likely would have lived to 100, mirroring the longevity of relatives. The emotional impact on the family, who have since been displaced from their damaged home and are now raising funds for temporary living expenses and funeral costs, has been devastating. The Independent and DNA India both note that the driver, Michael Butler, told authorities he had the Tesla on autopilot or on an automated driving assistance system at the time of the crash. Local officials, including the Harris County Sheriff's Office and the Harris County Precinct 5 Constable, have confirmed that Butler showed no immediate signs of intoxication and has been cooperating fully with the investigation. At this stage, no charges have been filed, and investigators emphasize that their work is ongoing. A separate report from the Daily Mail adds further details, including residential doorbell camera footage that appears to capture the vehicle barreling through an intersection, veering off the roadway, and striking the home at high speed without obvious signs of braking. The impact was strong enough that the car ended up deep inside the structure, in an area used as a playroom for the family's 3 children. According to these outlets, the scene after the crash showed extensive structural damage, with debris scattered across the front yard and a large breach in the exterior brick wall. Family members recounted how they initially scrambled to locate the children and each other after hearing a sound they likened to an explosion, only to discover that Avila had been hit. She was later pronounced dead in the hospital, transforming what had been an ordinary evening into a sudden family catastrophe. For Tesla investors and enthusiasts, the key issue is whether autopilot or another assisted driving feature malfunctioned or was misused, and how regulators will interpret this event. Authorities in Harris County have said they are actively investigating whether the automated system was engaged and, if so, how it behaved in the moments before impact. They are reportedly consulting people familiar with Tesla vehicles and working closely with the driver to understand how much manual control he exerted. The Daily Mail and other outlets also highlight broader concerns critics have about the branding of Tesla's driver assistance systems. Although autopilot and full self-driving are not fully autonomous systems and require constant driver supervision, some safety advocates argue that the naming and marketing can give drivers a false sense of security, leading them to over-rely on the technology. Online reaction to this Texas crash has already included skeptical comments questioning why a Tesla would be traveling at such speed through a residential area and whether the driver may have misused autopilot. For regulators, this incident arrives in a context of already heightened scrutiny. The Daily Mail recalls that in recent years, the U.S. National Highway Traffic Safety Administration has opened and escalated investigations into millions of Tesla vehicles over autopilot and full self-driving behavior, including allegations of running red lights or driving in the wrong direction. Any fatal crash linked, or even perceived to be linked, to misuse or failure of driver assistance features could influence future regulatory actions, including possible software changes, tighter usage rules, or even broader restrictions. From a market perspective, Tesla's valuation embeds expectations that its self-driving technology will eventually justify premium margins and entirely new revenue streams, such as robotaxis. Every high-profile accident risks slowing regulatory approval, shaping public opinion, and increasing the cost of compliance or potential legal settlements. At the same time, as investigators have not yet determined whether the technology malfunctioned or whether this was primarily a case of driver behavior, it would be premature to draw firm conclusions about the system's performance in this specific crash. For Tesla enthusiasts, these stories are a reminder of the dual nature of innovation in transport. On one side, the enormous promise of automated safety and convenience; on the other, the sharp focus that falls on any failure, especially when lives are lost. The coming weeks and months, as Harris County investigators and possibly federal authorities release more information, will be critical for understanding how much direct impact this incident will have on Tesla's Autopilot and full self-driving roadmap. According to Klein Zeitung in Austria, Tesla's full self-driving system, or FSD, is facing continued skepticism in parts of Europe, with Sweden's transport authorities raising fresh concerns that could affect the system's approval across the European Union. This development matters to investors and Tesla fans because the European market is large, heavily regulated, and often sets precedents that influence other regions. Klein Zeitung reports that Sweden's National Transport Administration, known as Trafikverket or TRV, has expressed serious reservations about granting EU-wide approval to Tesla's FSD package in its current form. The primary issue centers on the system's ability to exceed posted speed limits. Swedish authorities are reportedly proposing that they will vote against broader European approval for Tesla's FSD unless Tesla disables or removes the option that allows the system to drive over legal speed limits. From a regulatory and safety perspective, this is a fundamental clash. Tesla has historically argued that allowing some degree of flexibility around speed limits can be necessary for safe and natural driving behavior, for example when overtaking or matching traffic flow. European regulators, and especially Nordic countries such as Sweden with strong road safety cultures, are often much stricter and prefer automated systems that robustly enforce speed compliance. For investors, the Swedish stance signals potential friction during FSD's expansion beyond North America. Even if Tesla's technology is technically ready, regulatory bodies across Europe may insist on limiting key behaviors such as speed offset, lane change autonomy, or other aspects of the driving profile. That could lead to region-specific software variants, additional engineering and compliance costs, and a slower or more fragmented rollout. Klein Zeitung's brief but pointed report underlines that this is not merely a technical debate, it is also about public trust. If regulators perceive that FSD encourages or even permits rule-breaking behaviors, such as speeding, they may choose to block or delay approvals until such features are curtailed. Tesla already faces a dense patchwork of regulations in Europe, and any high-visibility pushback from a member state like Sweden could influence the positions of other EU countries when they coordinate on automotive software approvals. For Tesla enthusiasts hoping to use FSD in Europe with similar capabilities to North American versions, Sweden's opposition may mean that some functions could be disabled or limited by law. For investors, this reflects a broader theme seen across today's stories. Tesla's software and autonomy ambitions are not just an engineering challenge, but also a regulatory and political one. The way Tesla adapts to European safety expectations will shape both adoption rates and the company's reputation in one of the world's key electric vehicle markets. According to T-Online in Germany and Folha in Brazil, SpaceX, another company led by Elon Musk, has just received the lowest possible ESG rating from the major index provider MSCI, and this could have indirect implications for sentiment around Musk led ventures, including Tesla. While this news is not about Tesla directly, investors often view the Musk ecosystem as interconnected, and ESG trends increasingly influence how large funds allocate capital. T-Online reports that MSCI has assigned SpaceX a CCC sustainability rating, the worst grade in its system. This rating was dated retroactively to June 11th, just before SpaceX's massive $75 billion initial public offering. Such a low rating is rare. T-Online notes that a similar level had been applied to Russia on MSCI's government ESG scale after the invasion of Ukraine in 2022, highlighting how severe MSCI's concerns are. According to both T-Online and Folha, MSCI's main criticisms focus on corporate governance and controversies. SpaceX scored only about 3.2 out of 10 on governance metrics, reflecting what analysts see as extreme concentration of control among insiders, potential conflicts of interest, limited board independence, and weak oversight of executive compensation. In the controversies category, MSCI awarded a score of 1 out of 10 and flagged SpaceX with an orange warning signal, signifying involvement in serious ongoing issues, though not yet at the very highest level of severity. Experts quoted by these outlets described SpaceX's governance situation as close to a horror story for public market investors, especially for those who must adhere to strict ESG mandates. The timing is critical because European asset managers are examining whether SpaceX meets the European Union's sustainability disclosure rules. If it does not, funds that together manage more than €6.5 trillion may be unable to hold SpaceX shares on a lasting basis. Folha reminds readers that Musk has previously attacked ESG methodologies, especially after Tesla itself was removed from the S&P 500 ESG index in 2022 due to allegations of racial discrimination and lack of detailed low-carbon planning. Musk called ESG a fraud and accused its proponents of weaponizing it. Now, with SpaceX receiving the lowest possible grade from MSCI, that confrontation between Musk and the ESG establishment is likely to intensify. For Tesla investors, the direct financial impact of SpaceX's rating is limited, since Tesla and SpaceX are separate companies. However, there are several indirect angles worth noting. First, large institutional investors who are increasingly constrained by ESG rules may grow more cautious about concentrated exposure to any Musk-led entity if governance concerns appear systemic across its companies. Second, media narratives that frame Musk businesses as ESG outliers could influence public perception of Tesla in debates over labor practices, governance, and environmental transparency. Finally, widespread criticism of governance at SpaceX reinforces how central the theme of control and oversight has become across Musk's ventures. As Tesla leans further into AI, data, and robotics, investors can expect regulators and ESG analysts to examine Tesla's own board structure, internal controls, and risk management with similar intensity. Although this SpaceX story is not about Tesla's balance sheet, it is part of the wider context in which Tesla's stock trades and in which global funds decide whether to increase, hold, or reduce their exposure to Musk's universe of companies. Thank you for listening to Tesla Daily News. If you found this episode helpful, please subscribe and stay tuned for future updates.